Good afternoon, everybody. Welcome back to the Schwab YouTube Coaching Channel. Our next topic is market and sector analysis, and I'm your host, Kevin Horner. I'll tell you, things have changed a little bit since I was on this morning with James Boyd, but that's the best part about being able to talk about the market at various times in the day is we get to react on the fly to what we're seeing. What's pretty interesting, obviously, are some of these moves. So I am very excited and pleased to be here with all of you. Thanks to you for joining me. So if you're not already doing so, you can follow me and my buddy Cameron May on X. Cameron is there in the chat. He's already put that in for us, so you can see those in the notes. Cameron May CS and Kevin Horner CS. Great way, obviously, to get in contact with us or follow along with the charts that we might be offering you there in the land of X. At least I've posted a bunch of them today. There's been some really interesting stuff developing. So, like I said, happy to be here and get down to business with all of you. We are going to look at things differently than we did this morning. So if you are on for Trader Talk, you're in for a treat because we're basically going to expand what we've talked about and start looking at some longer term levels. So we're going to hit up some weekly charts. We're going to look at some Dow theory. We're going to look at market breadth. We're going to look at the returns on a relative strength basis for the last week and beyond that as well. So, I'm glad to do this. And really, as we tie a bow on what's been now a tumultuous week, we might have some things that are going to kind of maybe let us know that things are not as perfect as we had thought they once were. And I mean that because you're going to see some red candles on the screen today. So let's get to those disclosures, everybody. Remember that our conversations here are exclusively informational and educational. We do not make recommendations nor endorsements here for any approach to trading the market. We do discuss, however, technical analysis, and it's important to remember that technical analysis should not be the only means of your investment research. That means you should consider fundamental analysis and deeper levels of research, balance sheets, etc. Make sure that you're going through your paces, making decisions on a multitude of factors, not one single piece. All right, now with that in mind, here is where we are in the SPX. Now, I said it's going to look a little different. Well, yeah, that is a little different, everybody. That is the biggest single red candle you can find on this chart, dating back to when things got hairy back in early April. So with this in mind, I'm curious to know, who got stopped out of positions today? Go ahead, raise your hands. I certainly got stopped out of positions today. That's okay. That's part of our process. Who got stopped out? Who maybe decided to sell? My hope is that you took some steps along the way that encouraged you to take action. And what I mean by that is you allowed price action perhaps to dictate what you are doing in your trade approach. Maybe the move through the 20-day moving average in the SPX was a reason to reduce some risk. We don't know if that's the low of the day here, just shy of 6,600, right? We've got 58 minutes remaining in this session. But the news from the President Trump today stating that he's considering, imposing massive tariffs on China due to what he termed to be a hostile approach to the trade conversation has completely shifted our market, okay? Now, what we've been talking about for the better part of the last 3, 4, 5 months here has been that momentum, and the momentum has been great to the upside. But today's candle in the SPX, in the NDX, in the RUT, in the SOX, all of these could just spell a little bit of that finally the pullback that many of you have said, I can't wait for us to get that opportunity, to get that pullback so that we can start talking about entrance at lower risk or more comfortable levels in the S&P 500. And maybe that's the 50-day moving average. Like I said, we've come to the 6,600 ledge. The 50-day moving average is 6,530 at the moment. Every reason to expect that we could get there. We at least have to be prepared. I don't know if we're going to make it, but our probabilities of testing the 50-day are now greater than they were when we spoke this morning in Trader Talk. Let's do a couple of things along the way here. First, I'm going to apply the Fibonacci sequencing. We're going to draw this to our peak that we just made yesterday. And I'm going to point out, if we were to make a drawdown to this 6,300 ledge, it would be within reason for a standard, considered what many would consider to be a standard pullback, right? Because we are basically right at the first possible Fibonacci level. That move, for the record, in terms of percentage, would be about a 7% drawdown. Some of you are going to say that's going to stink, and you're not wrong. If we get there, that'll feel pretty ugly given what we've been doing for the better part of the last 4 months, 5 months, grinding higher, right? That grind leads to certain things like, unfortunately, complacency from time to time. We're going to challenge that, hopefully keep y'all away from complacency. When we look at it on the weekly, that candle today now becomes pretty uninspiring, right? Kind of a little maybe concerning. Notice there, my white line, this is still the 23% retracement, everyone. The upsloping period here, this is the 20-week moving average. That 20-week moving average could be support as well. So we've got an area where we could expect to see the S&P get a bounce. If having traded through, I should say, last week's low, longer range traders might be expecting a little more now weakness, or at least the increase to the probabilities that we could still move a little lower here, right? So as always, we don't know what's coming, but we position based on some of these moves. And having taken out the 20-day to this point on the S&P, having taken out the 20-day on the NASDAQ 100 here, if we close this way, many traders would look at this as the opportunity to start getting a little more defensive with their portfolios. The question I have, of course, is how comfortable are you now sticking long heading into the weekend? If you haven't taken action today, is it because your time frame's a little longer and you're saying, hey, no problem. We've got a broad, developed, longer range trend. If we visit the 50-day in the S&P, or if we visit the 50-day in the NASDAQ 100, that you're going to be comfortable? I hope so, because I think that what we're seeing is a greater likelihood of getting there now than we were, like I said, just in the morning today. So the NASDAQ below, look at this. If we zoom in a little bit, I want to give you these percentage moves once more, made a new intraday all-time high. If we visit this ledge, you're looking at about a 5% pullback, 5.25%. Okay. James, I'm so sorry, buddy. I know, because you've mentioned on multiple occasions that this has not been the year for you to buy breakouts and that you've been denied frequently. You know, this is, man, I just feel terrible because I know what you're dealing with. You do have to laugh. You're absolutely right. The good news is you likely were properly positioned. You saw the writing on the wall. The negative news kicked you out of the trade quickly and you limited losses, I hope. That process stinks, though. I know. I'm with you. I can relate. It does feel kind of like, oh, man, when we were feeling really, really good today, we get this headline and now we've got to be concerned again. So unfortunately, that's exactly what we need to do. We have to digest this news. We have to digest the potential for this to really hamper the markets. If this rhetoric is going to continue through the weekend, into next week even, we don't know. But it's certainly put a bit of a kibosh on our strong rally that we've been seeing. So the next question, of course, is, what comes beyond this? Is it a deeper pullback? Is it going to be opportunity? And now I say this is really the best chance to start thinking about, where will I look to deploy money if I am comfortable doing so? As you often hear me say, everyone, it is our job as traders to think that the unexpected can happen. We have to choose lower levels so that we are prepared to visit those levels. You know how hard it is to deploy money at the right time. Even though you might want to buy into the Russell 2000 at around the 50-day moving average down here, if and when we get there, you might not be feeling all that excited about putting money to work there, right? So I understand that. I'm not suggesting it's easy, but I am suggesting it's important that you pick the levels where you would have that comfort, where you would have that ease, and then start to put yourself into those positions, or start to follow your trade plan that'll give you those opportunities. Let's do a quick Fibonacci move on the Russell to give you an idea there. You'll notice that the move through that would have to take you back to what would be considered prior highs. Prior highs could be considered a former resistance, now potential support. So I'm going to make that a green line to validate it. And there you go, right around 23.15. And there's those prior, they were highs at the time and then became, so resistance became a pause right here. And then we broke it and then trended. And now this could become the throwback spot for a pullback like this, right? Let's see. Yeah. News always happens. The reaction to the news is the key, right? We've had some negative headlines along the way, everyone. You all know it. We've seen some negative headlines, but the negative headlines have been your buying opportunities. The biggest difference that I can see right now is that we're not getting any bounce. There's not been any give back on the selling, right? The selling has been strong, and I think it's topical or topic relative, meaning it's the word tariff. How long has it been since we've actually had that as a negative headline? Well, it's been a little bit. And again, the context around the president's commentary today, I think, is what has led us to the aggressive pullback. Now, we always say we don't know what's going to lead to the opportunities provided, right? We don't know what news headline, what catalyst is going to give us the opportunity for some profit taking, but I think that's what we're in the midst of today. We're clearly seeing some profit taking on many moves that have been pretty strong to the upside here in the last 4 or 5 months or so. All right, now, so you're looking at the semiconductors here. We'll notice that our breakout has led us to trending along the 20-day moving average in orange. We've not visited that yet. That candle today, not beautiful, but we're still holding the 20-day here. Don't get beyond your comfort zone necessarily, though, because when you look at a group that's been a leader, yes, the S&P 500's under the 20-day. Yes, the NASDAQ 100 under the 20-day. Those are big, broad individual group moves, but your leader has been the semis. So always be thoughtful. If we're getting leadership from a group A, well, then you would maybe expect group A to be the first to bounce, right? So be considerate of that. Now, if we want to look at a couple other broad things here for you today. I've brought some charts that you might be familiar with. Our friend Rachel Deshelle has provided previously the market breadth chart. Now, she comes to the show frequently with me. Some of you know of Rachel, of course. She's now a coach here with us. This chart really does a nice job of exploring some of the breadth of the broader market, and it's intriguing today. Notice we've got NYSE stocks making new lows, ticking higher, moving to some levels that we haven't seen down here since back in April. What a surprise. So that all coincides with our sell down here. New stocks making new highs. We've got a little bit of a divergence to that extent. So in the NYSE, at least, new highs have been trending lower. So we can make note of that. We've also got 50-day moving average stocks in the S&P 500 trending lower. Okay, we have to make note of this as well. In fact, trading to a new short-term low, also the lowest since late April. And then something similar with regard to the 200-day in the S&P 500. A little bit of a downtrend here and pulling back. Now, this would be considered perhaps more worrisome if we happen to make a new short-term low here in the SPX stocks over the 200-day moving average. So this is a line we would like to see held because that would tell us that the longer range chart is valid or good, still in a bullish scenario, whereas those under the 50-day, remember, that is a time frame more immediate or intermediate in term and in nature, right? So I think it's important to keep that in mind as well. All right. Now, how about some Dow theory? This might present a little Halloweenish, everybody. Take a peek at this one. So we had the Dow Industrials move to new all-time highs. We had the transports move to new all-time highs, but they did it in November of last year. And transports as a group are typically considered leader in terms of movement. Well, we made that high in November, then we didn't make a new high in the Dow Industrials until just last week. But now we've got a lower high in the transports and a rejection at the lower high level, the apex of my little head and shoulder, not head and shoulder, excuse me, my little triangle in here. Because what we did was, this was a beautiful uptrend line that was green, but unfortunately now it is red. And that's because it was support along the way. Then we fell through it. Now it can become resistance. So what did we do? We rallied into it and failed. And now we are in danger of because we've made now a matching low here in the transports, heads up. Lower lows from here could be coming. Doesn't mean it has to happen. This absolutely could be a bounce spot, but it is notable for the longer range viewpoint. Okay. So we at least have to be considerate of this. All right. Thanks for asking, Art. We're going to get to quickly. Let's hit up those positions that have been working so well. So I'm going to lead with the dollar really quick. I want to show the dollar because the movement with regard to gold, silver, Bitcoin, Ethereum has been kind of tied to the dollar. Now the dollar is coming back a little bit now. Probably on this concern around the health of the U.S. economy, if in fact Chinese tariffs are implemented. So you've got the dollar pulling back. As such, you've got gold, which was under pressure yesterday, turning into what is today maybe a bullish harami where it looked bearish harami earlier in the day. So far, we have basically held the low in gold of the last four sessions, excuse me. So monitoring in gold, this 39.50 area makes some sense because it has basically, as I see it, utilized this negativity associated with this headline risk today as a reason for a bounce in gold. And I think you see something similar in silver, albeit a little more volatile. Notice the tails in here, not as clean a move in silver. Now, Ethereum and Bitcoin both sold down because, as I imagine, what we're seeing is a little less comfort with risk all of a sudden. Because, again, what do we know? We don't. What we have is a headline with a fair bit of rhetoric around the word A, tariff, and B, massive. So when you say massive and tariff and you put them together, that's not exactly ideal. So Ethereum pulling back, breaking the confluence of the 50 and the 20-day moving averages. And I think now what you're looking at are traders suggesting there's a greater likelihood, of course, to visit the last level, 38.5 approximately, 38.50 on Ethereum. Now, how about Bitcoin? Well, that's what happens. Your bullish flag did not hold, and now you've got the retreat to the 20-day. We'll see if that holds. If not, you got the level beneath from which we've started that rally, maybe about 109 up to about 111 as a range of support. But that's why you draw these things in, everyone. My hope is that traders that were looking at it were thinking about it and saying things like, well, if this doesn't do that, then I need to do this. Or if this occurs, then I need to do that. Whatever those steps are, have that plan. Know how you want to move on. Okay, let's also take a quick look. We talked about yields a little bit. So the yield here is dropping. So yield falling. This is obviously a positive, you would think, for the broader markets. Positive for the Russell in the longer run. Yet this is a negative as it relates to maybe the overall health, I guess, but I think it bears monitoring. I said it in class this morning. We just got to be worried if we see rates rising as it relates to the Russell. This is actually good in the longer run for the move in those interest rate sensitive groups. Now, you might think that means that things like home builders are ready to rock and roll, but you're going to find that they're also struggling a little here today. In fact, we took out an area of support. There was a lot of belief that we were good and we were going to hang in here at the 50-day, and we didn't. So what did we have? We have some traders might tell you it's a little bit of a head and shoulder, right? A little left shoulder here, right shoulder here, head up here, neckline right here. That's not ideal for a number of reasons, and I'm bringing this up because that green line is the neckline, or it was the most important level we had to get through on the way up, because it was resistance, and then it became support. And now once more, unfortunately, everybody, I'm going to do that. Darn it. I hate it when I have to do that. We got to make it red. So now we're utilizing that as potential resistance. What are we talking about in terms of a measured move? Could it be that we take the height of our head and shoulder pattern, and let's take that line, add it to the red line, and that puts us, how about that, at the last low, interestingly enough. Well, that gives us something to keep an eye on with home builders. So there you go. Keep a close eye there. Doesn't mean you got to get down there. Obviously, the 200-day could provide support. It could also bounce for any number of other reasons here on a headline. So don't get too tied to our levels as we do. Let's just make sure we're going through the proper paces. And then one more Fibonacci. Let's see if we get any coincidence here. Well, 61.8%. That really would be your last ditch effort, right? Many traders would tell you, if you're utilizing Fibonacci's, you can make this upward move and give back as much as 61.8%. But if you give up any more, now the expectation is the return to the level from which you drew that Fibonacci sequence. So expectation under 21,000 in this particular index might suggest their greater likelihood of returning to 17,640. Hope that's helpful in thought process and in concept of how and why you might consider utilizing something like the Fibonacci sequence here. All right, the one thing we need to hit. What about here it is, CME Fed tool. So we've got the third party CME Group Fed tool. Reminder that this just simply tells us how traders and investors are, well, more likely traders are positioning for the potential for rate cuts going forward. Now, at this point, the expectation for October is a rate cut of 25 basis points. And then if we move to December, you're going to see that 25 more points beneath is suggested here, or not suggested, but is expected based on how traders are positioning and putting their dollars at risk. So that would mean expectation for 50 basis points between now and the end of the year. That would be significant, of course, and that's partially why we've seen the broad rally that we have in the major indices, right? The expectation for lower rates leading as a tailwind for many of the smaller cap securities and such. So bearing that in mind, in the longer range, hey, this is positive, but all the while, we have to remind ourselves that some of what we've seen in the last few months has been this grind higher with an abandon that just couldn't be matched with selling. Nobody wanted to sell. And when you get the pressure release is commonly when we go through these opportunities to revisit trend lines and consider opportunities. So I'll tell you, this is a very interesting scenario playing out today. The fact that we have seen a continued amount of selling here, I think, is really constructive, to be quite honest. I mean, it's necessary for the market to give traders more opportunities in the future. We'll see if it validates, I guess. So, quick revisit here of our SPX. I wanted to throw up the 15-minute bar chart to give you something to keep an eye on. Remember how we've talked so frequently about the importance of maybe the pivot levels when you're monitoring the market. As you can see, when we got that first story here this morning, we took out that first pivot and we slipped immediately to S1 and then slipped quickly through S1 to S2 and then quickly thereafter to S3. They have been very small bounces along the way. And what have we done? Any bounces aren't even making it to the 20 EMA, the 20-period exponential moving average has not even been tested to the upside yet. So our bounces have been very, very limited in the SPX, equally limited in the NASDAQ 100 and the Russell 2000 and the SOX. And so what's the takeaway? Well, the takeaway is consistency of selling, broad market selling, hitting multiple areas of the market, profit taking on a large move to the upside. Now, the reminder that I think is important, regardless of what space, sector, industry we're monitoring here, everyone, is that we need to be disciplined along the way, right? We need to have these expectations for pullbacks. And then when the pullbacks come, we need to be disciplined on our willingness to enter. And what I mean by that is it's important to set some levels for yourselves. Do you want to be the trader who's going to look at, for example, in the SOX, the move we've made since the breakout, which may make sense for some traders? Maybe the trade is all the way back to the move we've made since here. So when we start talking about things like using a Fibonacci sequence, like so, you can see, does that line up with something? Sure, it does. Lines up with the 50-day moving average. Could that be a level of support? It could. But what if the trader was a little time frame different and said, you know what? I'm not looking at it for the last 6 months. I'm just looking at it since it broke out. And since the breakout, we could say since the actual break, let's do that same thing, here to here. Well, now we're at the 38% level. And now the trader who's a shorter term trader could look at this and say, boy, maybe I am in the right time frame here if it finds support at the 20-day. Right? Because that's going to coincide with the 50% pullback of this move. And that is often a level to which we pull back on these rallies, right? We often see moves to the upside, pullbacks of 50 to 61%, then continuation of the uptrend in place. We'll see if continuation move happens. But again, lots of action here. Now let's hit some of these sectors for you all. I saw Art, I got your question there on oil. So energy breaking down, energy falling through my uptrend line that I've drawn in, and it's likely tied as much as anything to the move in the per barrel today. Art, look at this. We fell through that support we talked about this morning, didn't we? Right through 62, pretty aggressive. Suddenly we're at 59, just like that. So oil off 4.25%. Now, positive from oil moving lower, disinflationary for the U.S. economy. That's a good sign. But the selling in oil today, at least, as I see it, is likely more tied to the idea of a slowing economy if we are talking about tariffs on China, right? There have been some stocks that have been absolutely hammered on this move. The first one that comes to mind is actually in discretionary. Let's look at discretionary here for a second. So discretionary, breaking not just horizontal support, but a 50-day moving average. I'm sure you all heard that audible, involuntary, Well, you know what? That is an ugly candle at a pretty important level, okay? So discretionary pulling back off 3%. And now that we're down under the 50-day, the question becomes, can we get back above it relatively quickly? I noted today that a big move was happening in Tesla, one of the larger ones in discretionary. Tesla kind of breaking on a level here as well, took out I thought there was maybe some support in the 425 area, but 415 could be an important spot. Let's look at this one. Yeah, you can see, boy, as a developed trend, this is not, I mean, I guess we could look at this and say, you kind of got a little head and shoulder situation happening in here, right? Something like so. There's a left shoulder and then, a pretty spiky head here, followed by a very spiked and right shoulder that now has failed. And if that's the case, you might be in the midst of looking at a breakdown from, a neckline basis, like right as we speak. That's kind of interesting to keep an eye on, but it's one of the leaders in that space. It's not the only space getting beaten up here. Of course, we could take a peek at technology, which is a big candle through the 20-day. We'll see if that one can maintain, but it's also in danger of closing below the 20-day. And so, of course, it probably should remind us all to have a definition of what you deem to be considered a confirmation of a breakout, confirmation of a breakdown. Do you need a couple of closes below a level? Is it 2 closes in a row? Is it the first close? Is it 3, 4, 5 closes in a row to validate a breakdown. Have those definitions in your pocket ready to go so that on moves like this, we can take the steps necessary. Okay. So, boy, we have really worked through a lot of this stuff rather quickly. So, of course, you've got to chat. Make sure to use the chat. I'm sure there are areas of the market you'd like to ask about. I don't always have an enormous amount of immediate time to do that. And I think today we do. So spend the next 10 minutes with me, letting me know what you're watching. But let's think about it broadly. Think about it from some of these spaces that may have been moving for you. And let's start looking at some of these areas that are pulling back. But I do want to hear from you. Notice we've got the communication space also pulling back. Interesting level here for a potential bounce right at the gap zone in communications. Pretty important level to hold, right? And you're right. Great point, Riceberg. Utilities holding up. So there's a bit of a rotation here. Utilities is hanging in there. It is not green, but it's holding up on a relative strength basis far better than anything else. Probably tied directly to the move lower in yields, right? As now you might look at the move lower in yields and the risk-free rate of return back under back under 4.1 and nearing 4%, some traders might start thinking, hey, I can get a more clean rate of return relative to utilities with less risk or with a little bit of risk that I'd be happy to take. They might be leaning that way. There have been some positive moves in that space still. I'm thinking of some of the power groups. I wanted to pull up a couple of these. Like LEU in the power space. So you see, you had a high chance to break out today. Did not break, but it's hanging in. Notice how that trend, that's not even a 20-day moving average, everybody. I'll bet that that's a 10-day. Let me see if I don't have a 10-day on there. I should have. So we'll leave it as is, but that's probably a 10-day catching the bottoms of this most recent moves. Another one that made my wire today, at least, was Oklo, which was huge move to the upside, try to break out. It's still having a positive day, but you can see it gave back quite a bit on this headline risk today. Yeah, good point. Aerospace and defense. Let's look at how's Boeing managing this today. I'm going to go ahead and increase my chart. So Boeing selling down a little bit, pretty important ledge to maintain if it can. And planes in general, let's do that. EWC Aerospace. There we are. Well, I'm going to say this. So here we are, everybody. We've got an former uptrend line that broke and became former support can become current resistance. And that's exactly what we did. So we rallied back into that line and now we are lower. So made a move up to that ledge. That's a high trade on that rally. Today we've traded below the low of that high day. You could be looking at a revisit maybe of the 200-day moving average in that space, that aerospace as it were. Healthcare and some of those big boys. Let's see. You mentioned United Health. Let's take a look. I think I had a headline on United Health from this morning. I'm not mistaken. Maybe I am mistaken, though. There's been so much going on today that I'm feeling quite scattered, if I'm being perfectly honest, because things have been moving so much. Let's look at United Health here and see what's going on. So United Health had been in a lot of correction mode lately, right? Fixing what's been going on. And really, it's still hanging in there, all things considered. We're on the 20-day. It has basically been utilizing the 20-day moving average for now back to August 13. So almost 2 full months. Now, we filled the gap, filled this gap maneuver, right? Took it all almost good. My goodness, right to it. So I'm going to extend this out. And the high here was 376.22 was our high yesterday. And our low on the day of the move, 376.84. So we missed filling the gap entirely by 60 cents. But it's a good reminder, everybody, of why traders will look at gaps, not to suggest that every gap needs to be filled, but rather every gap can provide you an idea of where sentiment and supply demand might shift for you. It made perfect sense to be considerate of it filling the gap and then maybe pausing. And so now we're sitting back at the 20-day moving average, and we have got a decision to be made probably next week as to whether United Health can maintain that level now, right? So pretty intriguing chart from that standpoint. And I also wanted to point this out. I saw James, I got you on the heat map. Look at what's going on. My goodness, in the heat map side of things, a couple of stocks that are green are in energy. And then you had there's a headline associated with Applied Digital today. If we move off of the small caps, though, and highlight the S&P 500, you can see the limitation is really to staples, right? Philip Morris, and Altria Group, Mondelez, Pepsi. That's a nice move in Pepsi. That's pretty green there. So yeah, you're seeing a little bit more in the way of defensives here this morning or this afternoon now. Lots and lots of red though today. And I did put that one on X. I had to make note of the fact that it is red, red, red. Let's look at the quote breakdown, because one of the things I do have in here is relative strength on a 5-day basis, relative strength on a 21 basis, and relative strength on an 89-day basis. Ultimately, just to give you a little bit clarity about leadership and where it could come from if we were to see a different market. And so when you're thinking about this over a 5-day period and you're saying, all right, well, which of these is really our leader, assuming this is going to start to fill in for me, it'll let us know. But look at real estate, utilities, healthcare, staples. What do we know about those four? Those are defensives by definition, right? What do we want? You don't want leadership from those defensives. So we've seen a little bit more leadership now, or at least less selling in those spaces relative to what we've seen now in tech and discretionary, and even in industrials and financials today, which are pulling back. So they've been strong, they've been leaders, and now not nearly as strong nor as much leaders. This is not a terrible development. I just need to remind ourselves, and I'm hopeful to be reminding all of us about the way the market works. This last 5 months have been out of character to a certain extent. Maybe not the entirety out of character, but most recently out of character. The grind higher with no give back, no 2% drawdown in the broader indices. We need these opportunities. The market traditionally gives them to us 3 to 5 times a year, and we have not had those. So this grind leads to complacency, an unwillingness to sell, and a willingness to buy every dip. Things will shift, things will change. This is going to really start working on detailing our next opportunity. Is the next opportunity going to be bullish? Is it going to be bearish? We really don't know, nor do we know if the headline risk is gone. I feel like we can't say that. The one thing we've not had a lot of in the last 3 months plus have been headlines from the president that have squashed the market. The headlines haven't been as severe as today's. And today's severity is really why we're seeing a continuation of selling, why there's been no abatement to that selling, why it's just been pretty darn red since that headline hit. So let's move through a couple more of these and then we'll wrap it up. So there was your energy, which we talked about. Let's go back through here. So here's materials pulling back to the 200-day moving average. Could be an area for exposure, right? Industrials breaking the confluence of the 20 and the 50-day moving average. Could we be finding an opportunity here? Maybe. Remember, it's always a good idea to look left to confirm right. One thing that stands out, there are a number of tails here in the industrials down in this ballpark around 1250 for this group, this sector. So maybe keeping an eye on that level. That looks like it might be important. Let's see, just for fun, can we get a validated? So in the vicinity of our 23% retracement, probably shouldn't be shocked if we visited it, right? Let's keep on maneuvering through. In our final few minutes here, okay, we talked about discretionary, talked a little about Staples bouncing. Hey, Staples is not broken the 20-day on a close, so heads up there. It looked good in the early portion here, and then the selling got a little bit more aggressive. Now you're seeing healthcare pull back. You're seeing financials with a good candle. You're seeing tech with that good candle below the 20 now. Could it mean the 50? Maybe. And then, of course, we've got communications sitting on support, that level of the gap. Utilities holding up well. I'm going to go ahead and put a 10-day on there just to show you. I think that that's pretty much right on it. Just change my orange from 20 to 10. There you go. My goodness, we're too slow for the 10-day or too fast for the 10-day to hold. And then here's real estate, which is pulling back. And I'm got to say, that one stands out a little bit because that is also interest rate sensitive, and I might have expected that to hold up, but maybe not when you looked at the way that the home builders had been acting today now. So maybe some defense heading into the weekend. And then lastly, let's hit up that VIX. Look at the spike in the VIX, everybody. That's the highest we have been since the August 1 move. I'll remind you, VIX is traditionally considered to be a mean reversion scenario, right? We're going to see the VIX revert to the mean at some point. In the meantime, however, we might see the VIX continue to spike. So VIX spike, traders protecting heading into the weekend rather than selling. That can make some sense, right? If you're a trader who's in a been trading SPX in a taxable account, you might not be looking to sell and take profits just yet. You want to see how the rest of the year plays out. You might be owning puts to protect your long positions and your profits in the mean run here. So pretty interesting development in the VIX as well. All right. I think we are going to wrap it there, everybody. This has been first of all, I haven't done this class before. Really, really glad to be able to because of the importance of the close of the week and the significance of today's catalysts and headlines. Pretty interesting finish to things. So thanks to all of you for being here. Thanks to my friend there, Cameron May, in the chat. Make sure you're following us on X, Cameron May CS, Kevin Horner CS. We do archive this class, so please hit that thumbs up down below for me. I'm going to get this through the review process, and then we will get it reposted, and that thumbs up can help us a lot on the revisit and the the archival of this class, because many, many, many viewers will not have been able to see this one live, and your thumbs up can help me out. So thanks to all of you. I hope you all have a fantastic weekend. I'm off for about the next week to 10 days or so. Hope you all get a little bit of a breather this weekend. I'm going to get a large breather, but I look forward to catching up with you all again real soon when I get back. Have a great one, everybody, and stay well.